Good morning or good afternoon, depending on what side of the country you're coming from. Thank you for joining us today. Super excited with a great topic of our monthly webinar series, State of the Industry, Bank and Credit Union Transactions. So thank you all very much for joining us today. We're going to have a neat discussion about all the things taking place in this world. I'm Charlie McQueen, president of McQueen Financial Advisors. And fortunately here, I'm joined with Dan Martin, and Dan runs our valuations team and transaction advisory team. Dan is one of our three leaders, with Craig Cecilia, who runs our investment advisory team, and Heather Shepperly, who runs our ALM and analytics team. So Dan, thank you for joining me today.
Yeah, happy to be here. Should be a pretty interesting conversation as we wrap up 2024.
It's hard to believe that. I had an appointment earlier today, and someone looked at me and said, "I can't believe it's almost mid-December. I thought it was Halloween like 3 days ago." So it is moving by, and the year end is coming quickly. So, hey, a couple quick administration things. If you have any questions, please feel free to click on the Q&A button and type it in. We'll answer those questions along the way or at the end, whatever is more appropriate. Also, if you'd like a copy of the presentation, please reach out to your McQueen Financial Advisors, your MFA advisor, and they'll happily send you one. Also, it will be on our YouTube channel and on our website if you'd like to watch this again. So with that, Dan, we got a couple things going on here. What do we got going on?
Yeah, I think we want to give everyone a good background on, kind of what's happening in the industry, what we've seen this year, trends that we've seen year to year that are going to continue into 2025. Get into a little bit about the economy, some of the economic trends. For those of you that have seen our economic webinars, we'll get a couple updates there from Charlie. Look at what people are doing to really strengthen capital positions. As in any transaction, that becomes pretty important from the regulatory purview. Then get into earnings and margin, talk about how we can enhance those pieces, look at our M&A goals for 2025, and ultimately what we forecast in the year ahead.
Oh, bunch of great stuff here, Dan. Always, as usual, neat things to talk about. A lot of trends, a lot of things happening. So as we start off here, one of the things to say is what is this graph? What is it showing here?
Yeah, so here we're really just looking at FDIC banks, steady decline from the 90s. We've seen really the same thing across all institutions, credit union and banks. The one thing I find a little interesting here is you look at 22, 23, and 24, we're starting to flatten out just a little bit as far as declining numbers. I don't know that we're going to continue to remain flat. I think we're going to see continued consolidation, but last year with the SVB debacle, we had some slowdown in the industry. So I think we might expect that to ramp up just a little bit more in 25.
Yeah, you can see the flattening that took place. Also, we have things we'll talk quite a bit about today, AOCI and other things that are making some changes there. But another thing that's really hurting this is the lack of new charters, and this is a very personally disappointing thing for me to see a lack of new bank startup. De novos are super important, but what do you see happening here, Dan?
Yeah, I think what we've seen really is just the environment regulatory wise is just very hard for investor groups to get deals done, new charters specifically, or even acquisitions of existing institutions. It's very capital intensive. It's very time intensive. The process is just much more difficult today than it has been historically, and really that's why we haven't seen anything for the last number of years, substantial numbers at least.
And it's interesting as I look at some of the changes potentially the federal government at least talked about. Maybe there'll be a positive here that we'll see some more bank charters start up, because it's just hard to believe there was close to 170, 160 a year on a normal basis, and we've been down to, the high has been 14 since 2009. So really just a terrible set of events for the industry. But we're also seeing, Dan, here some trends in the credit union space. Maybe you could elaborate on these.
Yeah, similar to banking. I mean, we've seen a continued decrease in credit union institutions. Um, Interesting thing that we've seen this year is probably more larger institutions are looking at actually merging and consolidating. As you know, historically, we've seen this mostly in smaller institutions, but we've seen a pretty big uptick in interest from large institutions combining. They'll recognize a bunch of the benefits of putting themselves together, and we'll kind of talk about that a little later. But I think that's kind of a newer thing that we might see continue into 25.
Yeah, definitely continue to see those mergers, and as you said, it's some bigger ones, but we'll see here the pace has been fairly consistent up or down, and I do think even given the AOCI problems, my repetitive statement of the day so far, we're going to see that they're still taking place, which was surprising. I expected a little more of a slowdown with the AOCI problems. You agree with that?
Yeah, I think the last couple of years we've been in a difficult environment, with the yields shooting up how they did. It makes, purchase accounting and discounts on assets much higher in merger activity or just purchase activity. So being able to take on those considerations, you have to have a much stronger capital position. So, as that continues to improve, I would expect these numbers probably to increase a little bit into the future.
Yep. Well, one of the things is the number of credits and banks decline. A bit of it's done by transactions, and really, really amazing chart here. A lot of information floating around, a lot of conversations and interviews we're having based off this chart here. Dan, what is this talking about here?
Yeah, this is really looking at credit union bank purchases, and 2024 is kind of a landmark year. I think credit unions represented almost 20% of all bank purchase activity throughout the year. This is even a little bit of old data. This is October 9th, but banner year for that activity as you kind of get more players into the space, more people will get comfortable with it and employ that as part of their strategic plan. So I think this is something, you can kind of see the ramp up from really 2016, 2017. We've had a couple up and downs, but pretty much straight up. So I expect this to continue as more people look to get into the space.
Yeah, you can really see the numbers here, 13 back in 2019, 14 and 2022, but you can see the dollar value, 3.9, 5.15, and here we are at 18 at 10. So really some amazing changes in growth right there. A lot of fun stuff going on.
Yeah, it's been a good couple years, and I think when we look at kind of these transactions as a whole, this is a great representation. There's a lot of geographic concentration. So as we continue to see more of these transactions, we may see some expansion into, California or Texas or some of these larger untapped markets with a number of small community institutions. Most of this we've seen Washington, Florida, Illinois is very active states, but I think if you open the faucets on a couple others, we might see some much more activity.
It's interesting. You start looking at the geographic dispersion, what's happening here. There are not a ton of banks in Florida, but people want to be in Florida with the population growth. And so that's why we'll see the acquisitions in Florida and Georgia, um, Alabama. People are moving south, and that's we can see Kentucky and Tennessee move in there. But there's also some components of this of the number of banks and Wisconsin and Illinois, and the interstate banking laws came very late to a number of states along. Pennsylvania is another one. But we're also seeing some out migrations. Illinois, primarily Chicago, is having some fairly sizable out migrations, and so that's actually making some interesting deals potentially in that area. But really, it's one of those things you have to make sure you go back and understand the number of banks per state and the old interstate bank branching laws and when they change. So really, really interesting. Dan, the West Coast there looks really interesting to me. It's not a lot of deals. I think that's seven up there and three or two. But when I look at the bank deals, there aren't many up in that West Coast zone either, are there?
No, I think it's interesting. The state of Washington, for example, most of those little dots there are going to be credit union based deals. So most of the activity over there has been credit union focused. You can see kind of most of the bank deals in general are more East Coast, center of the country. So, um, it's kind of interesting that we haven't seen a lot of bank on bank activity on the West Coast this year.
Yeah, definitely slow on the West Coast, and there's again a lot of changes happening with migrations and people migrations, which is changing. So it's definitely interesting to watch. Um, so speaking of trends here, as we go to this next slide here, Dan, we've got some interesting trends.
Yeah, so this is really just highlighting kind of overall deal terms and number of deals. So, we're going to be up from last year on a total number of deals basis. I mentioned the SVB deal earlier that really drove down volume. Um, I think the big thing to point out is we did see a very moderate increase in pricing. I expect that to continue to increase back to maybe like that 1.4, 1.5 level we saw in 21. Um, I think looking at total deal values, though, we saw $10 billion of almost $11 billion of assets transferred. I think that's probably the biggest shakeup in the last couple of years is we're just seeing larger institutions trade hands.
Yeah, definitely some large institutional trading hands. And if you really look at the chart there, 2021, look at the number of deals, quarter four, 2023, and just a huge number of deals, and then just nothing. Amazing what happened with the issues with the AOCI once again, with regulatory side of things, which we'll talk more about the regulatory things. So life is coming back into the transaction. We can see it really ramping up in quarter two and quarter three and continuing into quarter four here. But there are some differences, and we'll talk a little bit about some of the things happening with the new merger regulations. But along with banks, we got to talk a little bit about branches, Dan. A lot of red on this chart, or maybe I should say there appears to be three greens and three blues.
Yeah, I think this is actually fascinating. This is really represents net branch closures in each state. So, you talk about California has 49 branch closures this year. New York's got 41, Texas 23. I mean, those are some pretty big numbers. Um, I think a lot of this is probably driven by larger banking institutions. You notice some of the more rural areas of the country, Montana, Idaho, Wyoming, South Dakota, North Dakota, are all close to even. But some of those more concentrated metropolitan areas tend to have larger losses. But I think this is a kind of signifies a trend of maybe the retail model for banking might be changing a little bit. We've talked about this on previous webinars. The size of a branch needed to operate today has decreased over the past 5 years. And so this is kind of affirming that trend, something we might expect to continue as people kind of re-strategize what that footprint looks like.
Yeah, Dan, I think you agree with you spot on this. We look at a lot of these areas that get the larger bank mergers. Those are the ones that are causing the biggest reduction of branches. The credit union acquisition of banks are keeping a lot of branches around. But it is interesting. Michigan here is the leader in the most growth of branches at 6. Rhode Island is at 5, Georgia 2, North Dakota 1. So really interesting that the growth is there, but some big changes. And I do expect, as you said, the size of branches is very important. And that's something where I do think there's some opportunity to cut some costs and improve margins with branch sizes today. All right, I mentioned this, Dan, and we talk a little bit about this. This has caused the slowing, a great deal of slowing of transactions getting accomplished. An interagency bank merger policy update came out. Not all the details came out. Is that right, or what can you share here?
Well, I think when we look at this, largely it's much ado about nothing, right? They put out this new policy effective October 28th. It really is just reaffirming their existing process, talking about diving into safety and soundness expectations, really just affirming that, you know, we can keep progress on these transactions while making sure we're doing our due diligence. So I don't see any new issues in either credit union bank world or bank merger transactions, really more so them affirming the process that's in place already.
Yeah, definitely it made people stop and think, and a lot of double checking and a lot of pausing of transactions where the regulators waited for the update to come out. I do think it's added a new level of questions. We've spent a lot of time with regulators to fill out their new questions and continue to provide information. So we are seeing things move forward. Hopefully it's a one-time slowdown. We're back to more of a normal pace now. All right, well, heading up into the economic trends section, I want to talk a little bit about what's happening and then some of the things that are going to affect us as we look at the transaction activity coming into this next year. Um, all eyes are on the Federal Reserve. We have a Fed meeting a week from tomorrow, if I remember correctly. And that meeting a week from tomorrow, expectations we have are for a 25 basis point cut. But that cut by the Fed or not cut by the Fed is based off of two things. Full employment is one and price stability is the second. And the full employment one is a little easier to show in graphs. We are seeing the unemployment rate come up a little bit closer to 5% in the nation. In Michigan, we have here as an example. And the length of unemployment is ticking up. but we're still at really, really low unemployment levels. Anything below 5% is considered full employment. So we're feeling good on the unemployment situation. And the definition of a soft landing is unemployment doesn't fall apart, stays good, and inflation comes down. And that's what a lot of people are hoping for right now. Our chief economist, Greg Cilia, is hoping for a soft landing. We hope that that's the case. We are seeing, though, inflation remain a little bit stubbornly high here, over 3%. And so that's what's causing some concern, but maybe the Fed won't be lowering rates 25 basis points next week because they want to keep rates a little bit higher to try to slow the economy a little bit more. One of the charts we've talked about for years is the cause of inflation, and it really goes back to the amount of money the federal government threw at the problem through the COVID timeframe, and then thereafter, and all the different acts and the Inflation Reduction Act, which are all been inflationary. It's caused money supply to explode. Now, one thing we're seeing is well, money supply exploded. It was really good. Then we saw money supply shrink very quickly. Money supply, as you can see in this chart, doesn't shrink very often, and that caused a lot of those liquidity problems, which is one of the things that made it difficult for transactions to get done in the last couple of years. What we can tell you from our investment advisory division, which we're really proud of them, managing about $17 billion right now, they're doing a great job of it, and they are buying bonds every day right now. The amount of inflowing cash is very significant, which should give us some indication that we are seeing some changes to the economic activity. So with that, we are seeing one of our big issues, AOCI, started to get a lot better. And this is a picture of the 10-year U.S. Treasury, and we had the yields come down for a while. Then we've had them pop back up here. And AOCI is obviously not just off a 10-year Treasury, it's off the entire yield curve. As we continue to see Fed hopefully lower rates a little bit, we get to more of a positive slope yield curve, and that'll help us with our AOCI get lower. And also as time goes by, securities get closer and closer to maturity date, so we're going to see a lower AOCI number. So we are seeing improvements here, which is going to help people get transactions completed. But the other side of things is yields have not come down substantially, which means that cash actually can get reinvested at some pretty darn good yields right now and help with earnings. That's one of the neat things we've seen for a while with cash, Dan, but unfortunately with cash yields coming down, that did make you really have to invest those dollars with a transaction, right?
Yeah, no, I mean, part of the benefit of doing a transaction is with purchase accounting, you can kind of restructure the balance sheet, right? So you can take advantage of, if you're recognizing a discount on the portfolio or the AOCI number day one, but then you can kind of reinvest those at higher cash yields or longer term, higher yielding securities, which really helps your go forward earnings.
Yeah, definitely helps big time. Well, with that, we do see that it will get better. It's going to take, and time does help here, but it should also remind us to have a good portfolio that matches your needs and not a portfolio that you're being sold. And that's something important our advisors talk about all the time, is getting the right duration portfolio. Well, speaking of portfolios, one of the things that we're seeing some changes here is car prices and car values. And in the credit union space, obviously, very specifically, and also in the finance space, we are seeing used car values come down, which is causing some concern. But we're also seeing new car purchases come down quite a bit. One of the things we're talking about here at the office the other day, is it a good time to buy a car? And a couple people are arguing it's a terrible time to buy a car because they're very expensive. The other side of the office was arguing that, hey, go look at Edmunds.com and you can see all of the 0% financing deals out there. So big incentive right now to get cars off dealer lots. That's an indication to us that the economy is slowing a little bit too. So this is another indicator, which means that maybe lending is going to be a little tougher, and maybe we don't want to use as solid or as high as projected earnings in loan projections in transactions. So as mentioned in the beginning of this, we do expect the Fed to continue on their trend of lowering rates. Now, the chart here is the Fed funds futures. The Fed funds futures are never correct. They're never perfect, but they're always a good indicator. But what you can really take away from this chart is basically it's a line. So the market is not expecting the Fed to cut rates very much. And actually the low point of rates on this chart is December of 2025, going down to 375. So not a huge drop from 450. So the market is not suggesting, and we agree with the market, until we see inflation really get under control, we don't see the Fed reducing rates substantially, but we do see them reducing them a little bit more. So a couple things to throw along there along with this. We have things going well from an economic standpoint still. Fed funds rate we project is going to come down here. We think we're going to get down to around 4% by the end of next year, mid next year. SOFR will come down along with that. Prime rate will come down along with that. We do expect to see a steepening of the yield curve with the 2-year Treasury coming down a little bit more than the 5-year and the 10-year, and get back to a nice positive sloped yield curve, which is a really good thing. That's how we actually make more money and our margin improves, is by having our longer term assets, which are usually loans, achieving a higher yield than our cost of funds on the short end. Along with that, we are seeing lending slow, which means hopefully we have excess demand of deposits, excess supply of deposits, got to say that the right way, excess supply of deposits, which will continue to help drive the cost of funds a little bit lower. So with that, I do expect to see earning improvements, maybe a little not as good because loan volume down a little bit, but that positive slope yield curves are really going to improve our earnings as we go forward from here. Dan, anything you want to add to that?
No, I think that that's a good segue to kind of the next piece to hit on here.
Which is what happens with earnings, you get.
Capital, yeah. So, this is obviously one of the big things that's reviewed from regulatory bodies, boards. Anybody that's looking at a transaction can be very capital intensive. You look at the credit union bank purchases, those are dilutive to your overall capital ratios. So, I think having everyone understand what we can do to potentially build up those capital ratios or what that looks like across the industry would be very beneficial.
Yeah, absolutely. Well, speaking of beneficial, ratios are always beneficial, right?
Absolutely. So, I mean, just looking at capital ratios across the board, we haven't seen a ton of dips outside of that 2020. You can kind of see how everybody dipped out a little bit, but we've seen some recovery since then. AOCI certainly has improved with that yield curve. So you look at, really all four of these lines here, and we've seen improvement from really September of 22. So that's something I would expect to continue. And if you want to flip to the next page, we can kind of talk through some of the different strategies we've seen employed. Um, First one, really looking at AOCI, I think we touched on that a little bit. That'll improve over time. Earning enhancement, that involves pricing everything correctly, making sure we're getting the margin we need to get on all of our products. But the big two that I want to touch on is really subordinated debt and sale leasebacks. Both of these within the last year have really picked up tremendously. Subordinated debt can be used to, cushion your capital ratio if you go through a transaction and dilute it. It's a very relatively simple process to get approved. Once you're approved, you can sit on that dry powder for up to 2 years without issuing. So really beneficial to get approved there. And then sale leasebacks is a newer one too, where if you're sitting on a building that has been on your books for 20 years, it's depreciated down to $1 million. You may be able to go and sell it to one of these sale leaseback funds. And recognize a $5 million gain on your balance sheet and earnings and really enhance your capital. So some really creative solutions there that I think a lot of institutions should be considering.
And it's amazing to me if you think about the two options you talked about there. Subordinated debt, talking about easy to issue, 8 to 9%, depending on all sorts of information about the individual credit. Great way of getting additional capital there. And I'll tell you, I like the idea of shelf registration at a minimum, because you have it up there if you need it, because maybe unrealized losses. Sorry, I'm thinking AOCI. You can look at the top of it. If credit problems start to pop up in your loan portfolio, the capacity to issue debt are already approved, just very quick to issue. The sale leaseback side of things is very interesting to think about minimizing your non-earning assets. And that's something that is, I think, a great conversation to look at and make sure we're structuring the balance sheet correctly. As we look back at what happened for the last couple of years, a lot of people's balance sheets were not structured the best possible way, and it made for a very difficult time with earnings right now. And so that whole balance sheet structure conversation is extremely important, and I can't wait to continue to have that with many people, as we've had it for years. Nothing new, but it's something to continue to have. But with that, Dan, the net interest margin is really key because going back to the previous slide, we talk about capital. Well, how you get capital primarily at our industry is from your net interest margin. Non-interest income, obviously very important, and we don't want to minimize that by any stretch. But the net interest margin is what's really driving everyone's earnings here. And we are seeing some interesting numbers here, Dan.
Yeah, I look at this and say, generally across the board as a sweeping statement, most people had some ROA or margin compression, with cost of funds increasing from 23 to 24. Now, what I find very interesting here is if you look at that category of sub $50 million institutions, you know, 20 to 50 million was flat, under 20 million was actually positive. I think that's more of a reflection of them not adjusting their cost of funds, whereas, those larger institutions are probably a little bit more reactive to the market. Um, but I think it's been, we can see here it's been a little difficult on everybody with some ROA compression there.
This chart was actually surprising for me to look at that, and I think here this does show that a lot of people are proactive or reactive. I guess depends on the time of year a little, but active we should go with to reduce their cost of funds or to increase their cost of funds, reduce their margin to make those decisions correctly to retain and grow deposits. So super important. Do you see this turning around this next year, Dan?
I don't know that with the right decisions, yes. I don't know that we're going to see a huge fall off in cost of funds. So I think to me, this just makes pricing decisions on your loan products and cost of funds for that matter ever more important.
I do think it having more checking accounts is really going to make the difference for a lot of people here. But we are seeing here a bit of a unique changes when you start to look at it in the line graph over the last several years. This chart goes back from 2008 through today. What do you take of this, Dan?
I think the easiest thing is if we look at kind of the colors of these lines, the largest institutions can operate on the smallest margins, right? So if you look at the over 250 billion, they're at the bottom there. They can operate on the smaller margin just because of the pure volume. So I think really what that tells me is there's an advantage to scale. And so when you look at any transaction, that is one of the advantages is you get size and scale. So not saying that's the only reason to do it, but certainly one of the advantages.
Yeah, I think this also to me highlights, Dan, in this 2020, 21, 22 time frame, the larger institutions here really went after deposits early on, and then the rest of the industry reacted a little bit later. It did cost them from a cost of funds standpoint and a margin standpoint, but it kept their assets bigger through that time frame. So really interesting. Um, and this chart here, we start to look at it in a really unique structure where, I'd love for you to explain this to everyone, but what we're seeing here is definitely savings decline for small institutions and declining at a faster pace, and savings at large institutions growing, but even growing also at a faster pace year over year. I actually explained it, then I explained it basically. So what do you want to add to that?
No, I think that was a good explanation. I think this kind of gets back to this couple slides ago where the larger institutions are frankly reacting faster to a changing market, changing cost of funds, and they're able to capture more of those deposits. So, that's kind of why we're seeing the smaller institutions really struggle is they're a little slower to react on those types of accounts.
Yeah, definitely interesting to see that change. And you mentioned a couple slides ago the importance of scale, and here's what really shows. I know sometimes this chart's a little hard to see, but it's efficiency ratio. And the smallest institutions on the far side here run in a 90% efficiency on average. When you get to we're not even going to the largest, we're going to go to the 1 to 10 billion, they go down to a 65% efficiency ratio. So basically, a 25, 30% modification there, just incredible difference.
Right.
Yeah. So scale does help is what you're saying, right?
100%.
All right. Well, you wanted to share some of your goals in M&A with the group here, Dan. So I'm going to let you go through a couple slides here.
Yeah, absolutely. I think it's important when looking at mergers or acquisitions, understanding, why are we doing this activity, right? We see that it happens all the time in the marketplace. Maybe some peers are engaging in the activity, but why are they really doing this? So if you want to flip to that first slide, Charlie, we'll talk about some of the goals or benefits. We just hit on economies of scale, increased profitability. Typically, you'll get cost savings and earnings enhancements out of the activity. But really, it's a way to get into new geographic areas. Sometimes you may be going into markets that you're already in and you want to prevent competition from entering those areas. A lot of the benefit to what we see in credit union bank deals is picking up lending expertise. Traditionally, a lot of credit unions are focused on consumer lending, whereas, commercial banks, you might pick up some commercial lending expertise. So really a large varieties. And so understanding kind of all the pros and cons of every transaction is critical. But there are more than one way, kind of to realize that you should be engaging the activity. The other one I'll mention too quickly, news and headlines we have on here. I think every client we've done a transaction with can probably attest to this. But once you get your name out there, you tend to get a lot of people asking if you're interested in further activity. So just doing one transaction can really set off the wheel in motion on more potential activity, or at least being shown the opportunities.
100%. Also tends to get you normal or news in your local markets, which actually drives people to you. So free advertising in a lot of ways too there. So really good. Well, there's also some challenges though, Dan. Can you talk a little bit about those?
Yeah, I think the biggest thing that comes to mind for me is going to be retention of key employees, safety and soundness of capital, and really full-on integration, right? Because you're merging two independent institutions to one. You have to give ultimately one culture. You have one set of management. So that integration P, making sure you retain the people you need to maintain loan relationships or deposit relationships. Those are going to be the biggest things you focus on. And obviously, in a transaction, there's a lot of things you can do to mitigate those risks. Um, but those are going to be probably the biggest ones that I see.
Yeah, I think as we've gone through every transaction, think about it. The reason why we do transactions is a lot of times maybe to get into a business line or product line, but that involves the people. And so retaining the key people is absolutely important. And that's why we get sometimes a little frustrated with some of the timing changes of transactions. Now, we want transactions to move fairly quickly to keep everyone comfortable and get things done correctly. But definitely some challenges out there. I doubt there's a lot more positives in my mind than negatives. But there's also some great strategic activity to talk about in organic growth, Dan. And let's talk a little bit about this.
Yeah, I think this comes down to anybody that's looking at doing this activity. It's really a couple step process to get there, right? So first being you want to position yourself to acquire, and that's going to take a whole host of different avenues from a ALM risk management perspective. You're going to have adequate capital. So whether that be, maximizing your earnings today to build that capital, sub debt, sale leasebacks, that sort of thing. The next piece is really determining, okay, well, given what my 5-year, 10-year strategic plan looks like, how can I accomplish the growth that we need to achieve? So is that from organic? Largely, that's going to be driven from inorganic growth if you have large goals to hit. And so, we can work with you to come up with a good strategy and how to hit that strategy. And then ultimately, once you've done all that, what I'll call the base level work, then you can go search the market for something that applies to your strategy.
Yeah, I love that. And one of the things I've learned in life, I think all of us should always remember, is when you have a plan and you're working on going somewhere, people are attracted to that plan. So with all of this, positioning yourself to acquire is having your plan. What are you going to do? Where are you going? And really being prepared to answer those questions, which is really, really important. So strategies key to the whole process. There's other ways though that you can grow, and some other opportunities out there right now. And we have a number of people talking about mortgage companies that they're interested in them, which is not surprising given where interest rates are, but it's a great thought of where interest rates may go in some people's minds.
Yeah, I think certainly we've had a lot of interest in mortgage companies, people looking to potentially pick up them. at low refi volume. You might get some potential upside post-purchase. I think you should be looking at anything that is complementary to your customer base or membership base. So insurance companies, wealth management, those sort of things are kind of the typical low-hanging fruit. When it comes to credit union service organizations, on the credit union side, really any type of business can be that. But I would recommend looking at ones that either your institution already utilizes or can actively utilize post-purchase. It tends to be a little bit less risky than purchase something that you're not already a user of.
Yep. I do like this. There's many ways to grow, and keeping your mind open and looking at different activities. A lot of things happening in insurance today with everyone's insurance going up dramatically, a lot of opportunity to rewrite. And the stock market apparently only goes up. So that being the case, wealth management's a great spot today, and we're seeing more and more of our clients hop into that area. Well, Jan, as we look forward to 2025, let's talk a bit about what we see coming, thoughts, how to position some more, and different things. And maybe I'll kick off. We do expect economic growth to continue. We're hoping we hit that sweet spot of the soft landing. We'll see if we get there. There's also a lot of conversations about lower regulation. Everyone's got different opinions on political stuff. I never like to go down political conversations. I am intrigued, though. I can only imagine when I wake up every morning to see what Vivek and Elon did overnight. I just think it's going to be entertaining with the Doge, but we'll see how that all comes out. But hopefully there's smarter, better, easier regulation is probably a better word than lower there. Deposit growth, we are seeing it up with lending slowing a little bit right now, or utilization less in lending, but we also are seeing deposit growth up. People are saving a little bit more, so it might be a good indicator of what's happening. Loan growth has been flat to down in most areas, although we did see another big bump up in credit card debt, which makes me a little nervous there too. But we are seeing, we think, is a good environment for transactions, especially if we continue to have this little bit of a Goldilocks environment with low credit losses. You feel the same way, Dan?
Yeah, no, I would agree. I don't think there's anything in my mind, total economy wise, that's going to hamper us from, kind of increased transaction levels from what we saw in 24. If anything, potentially some accelerated transaction volume, given some of the pieces you just hit on.
Oh, you've got some other predictions here you want to go through.
Yeah, so I just mentioned transaction volume. I think competition is heating up. As we alluded to earlier, there's more players getting into the space. Unfortunately, one of the pieces or one of the items that drives is pricing, right? So we saw a small uptick in pricing this year. I think as we get further AOCI recovery, increased competition for deals, we might see some, slightly higher pricing on stuff. But I think the big focus is understanding what a transaction can do for you from an operations perspective, what can it enhance, but really focus on that earnings and cost savings potential. What can we do with it is going to be key, especially in the higher pricing competitive environment.
Yeah, definitely. You think about cost savings, and there are significant cost savings that can be done in transactions where you don't need an entire accounting department, legal department. Just so many different things can go away, and and making sure you actually look at those cost savings correctly and make sure you're making good assumptions on those is really, really important. A lot of times you see people that get really concerned and see a 40 to 50% cost savings, and I can tell you it's a fairly standard number, if not higher. So something to be thinking about with that cost saving structure. I do think, Dan, there's a couple other things here to talk about is how do you become a stronger buyer or a stronger merger partner? What are some of the things we should be doing every day to be positioned well? I'll grab the first one. Earnings is key. And I made a comment earlier that balance sheet management, we're probably going to hear this coming up season of people talking at conferences about the new thing called balance sheet management. It's not new. We've been doing it a long time. We've been doing it here for over 25 years now. Balance sheet management is a great thing to do, an important thing to do. And that's what asset liability management or interest rate risk management is. And it's making sure you don't have all of your assets in mortgages, both in the loan portfolio and the investment portfolio. It's making sure that you're well structured structured in all ways. And that's actually not being sold and not being sold different things, but determining what you need and implementing what you need and have the tenacity to make those decisions and follow through. Um, to me, that's really key. And that when you position yourself with a good interest rate risk structure, you're going to be able to be successful in any economic environment. And especially if there's a difficult economic environment, that's when you have the capacity to really pounce on opportunities and grow. EBPA, employee benefit pre-funding account. What is that there, Dan?
Yeah, so I mean that's something if you're looking to merge another entity in, or really just back to that focus on earnings, enhancing your earnings, that can be used in a variety of ways. Number one, to enhance your earnings, um, and strengthen that capital position. But also, if you want to offer a retirement benefit to executives that are merging into you or coming over to you, that can be a platform we can use to do that activity. So has a little flexibility. I'd recommend anyone getting that type of account set up prior to even going down the path of engaging in a transaction, just so you have that, kind of in your back pocket.
This is just core earnings. What I want to do, everything I can do to hit singles day in and day out. I want to structure my balance sheet the best I can, and that's one of those opportunities to get enhanced yields to cover expenses. So it's a bit of a no-brainer. Those first two things. Growing equity, Dan. What do you want to share here?
Yeah, I think this is what we touched on earlier. Getting pre-approved for sub debt, I think that's important. Gives you a lot of flexibility in looking at different transactions, knowing that you have the capacity to do so, even if your current capital levels aren't there. Also, you can get an assessment on branches, understand what type of gain you might have, what type of capital you may be able to bring back with a sale there. So, really, just understanding capacity there, I think, is pretty big.
Yeah, I think we really go through this process, you want to have everything in place the best you can, so you have as much equity as possible appropriately to be able to take advantage of opportunities. And doing some of this stuff early on is really that preparatory activity. It's prepping your balance sheet for what we don't know is coming in the future, but we hope incredible things. And not only do we hope, we make plans and activities to achieve those incredible things. One of the things that's been really interesting to me, Dan, is talking about foundations. We did a webinar series earlier this year in January, February. Got to look back. It feels like that was like a month ago, but January, February this year, we had a lot of comments and a lot of follow up, and a number of clients who actually started foundations. Why do you have that on this list here today?
So I think that's a unique thing. One, depending on your state regulation, it can be an earning enhancement activity. If you already have a foundation, you can use charitable donation account to fund that, thereby, providing some level of income back to your balance sheet from that expense. But I also think from an incentive point of view, if you're looking at a potential merger, what better to go into a community and say, hey, look, we'll set up a scholarship fund for X, Y, and Z, um, to kind of help facilitate that transition. You enter a new market, that's typically pretty well received when you're going in there and investing in the community.
Yeah, and that's one of the things you think about this. Whenever I do a transaction, I want to be able to go into that community and say, this is what we're going to do to help your community. We're all community-based financial institutions. Every credit union bank in this call, we are the community institutions anymore. And that's where we want to be there, which we can tie in and we can help local communities. So really, really important. And that ties in it. It actually helps with the retention of deposits, really important. Helps with retention of loan customers, really, really important. Next one is education. It was interesting. We've talked a couple times. Sometimes with working with a client who goes through a transaction the first time, it doesn't go through. We bid and maybe miss, or we don't get a bid in time. A lot of things may happen, but what we've determined early on, that a lot of that was just education. Ensuring that the rest of the management team understands how this works, making sure the board of directors understands. Dan, what kind of education are we offering to management and boards at this point?
Yeah, so I mean, we'll do as much as you might need, right? So full overview of process, detailed due diligence review. Really, we're gonna educate and make sure everybody is comfortable through a transaction. I will say it's funny, experience is the best education, but I would venture to guess that any of our clients that have gone through multiple transactions or looked at multiple transactions probably pick up something new every time. So it's kind of an ongoing education, but we're there to provide as much knowledge as we can.
Really important, and we're happy to do that anytime, in person, by video call, whatever's best. And the last one we have here today is really a proactive search. And to me, um, we talked a little bit about states earlier that have a lot of banks, states that have very little banks, and understanding what you want to do, where you want to go is extremely important. And once you figure it out, what's the right strategic structure for you? Maybe give us an example, Dan. Client calls up and says, "Hey, we have a desire to go to X location." Could they be as detailed as a city, a town, a state? How detailed do you get there?
Yeah, I mean, if you have a very specific, market you want to be in, very specific city, we can go directly into that market, determine who the potential sellers may be, and find an opportunity. Or you could be broad and say, hey, look, we're looking to grow, commercial banking in XYZ state, right? And we start with a kind of a broad market and scale it down as kind of we refine that strategy. So we can start really on both spectrums. But the big thing is, you'd much rather be proactive than reactive because those people that are going to be proactive are going to typically get to look at deals before anybody else.
Really, really important to be out there, understanding where you want to go, understanding what you want to accomplish. And the sooner you get that is the better. And one of the things, for example, Dan, when you work with clients in sub debt issuance, there's a business plan that goes in there. And what's that business plan? That goes back to your strategic plan. Really, really important that we think about this as a very strategic activity, not a jump off the hip. That has happened and will continue to happen. But the goal is to be very strategic and know what you want and know what to do to go forward. So really, really good information. I hope everyone can take that back and look for ways to go. So Dan, as you look at next year, what do you expect to see happen from a volume standpoint and activity standpoint?
I would expect 2025 will have more volume than 2024. We'll see more transactions take place. I think we'll see larger transactions take place at a faster pace than we saw this year. So I think the ultimate message is be prepared for that. We kind of outlined a bunch of ways where you can prepare, but be as prepared as you can be to take advantage of those.
So as I look to next year, I continue to see lots of signs of more and more credit union mergers, more and more bank acquisitions by credit unions, and bank mergers kicking up too. We definitely see all those things come into play. We've talked about it a lot. AOCI continues to improve as time goes by. That'll get better and better. We're also seeing a lot of people that thought the economy was going to fall apart, and credit losses were going to skyrocket. We've seen that not come to fruition, thankfully. And so a couple of those bumps in the road have moved out of the way. We are still seeing some people with concerns about the dollar amount of city-centric commercial real estate, specifically office city-centric commercial real estate. But that's the only spot that's been giving us a big concern, is what I share. All right. Well, Dan, I really appreciate the insight and information today. Great conversation. And I recommend anyone out there thinking about this opportunity to reach out to Dan and check in with him. He's got an incredible team that does this day in and day out. So again, Dan, thank you very much. I appreciate the time and insight today.
Yeah, appreciate it. Hopefully, everyone got some good nuggets of information, and please don't hesitate to reach out. Uh, any questions, concerns, anything you want to talk about.
All right. And one last thing before we wrap stuff here, I want to thank everyone for joining us today. We do have our economic and business update with early 2024 actions coming up here, our next webinar. That is going to be on January 17th from 2 to 3 p.m. So we're excited about that. There'll be a registration link sent out in emails. And if you like one, please reach out to your MFA advisor. Additionally, if you have any questions or you'd like a copy of the presentation, please reach out to Dan or your MFA advisor. We'll happily share everything with you. With that, thank you again, Dan. Appreciate the time.
All right. Thank you.
Have a great day, everyone. Thank you very much.